Okay, perfect.
So good evening, everybody. Welcome to this month's webinar. In fact, I think we've had more than one webinar this month. It's been a very busy month for webinars. But tonight, I'm really delighted to have on the line a guy who I met at Birmingham PPN, Progressive Property Network meeting, probably about 2 years ago, I think now. And at the time, Mike Holt, as his name is, he stood up and started talking about pensions. And, I think for many people in the room, we thought, what's this got to do with us? But I have to say, what he said was dynamite. And Mike and I have stayed in touch since then, and we've followed each other's progress. And I know that if you are looking to invest with your own pension or with other people's money, other people's pensions, Mike is the go-to guy. He knows exactly what he's talking about. He's absolutely the expert in his field, and he's got the track record and the case studies to prove it. So thank you, Mike. Hello, and thank you very much for being here this
Thank you,
evening.
Wendy. Thank you for that very kind introduction.
Well, it's great to have you on board, and you've done webinars for me in the past, or I think maybe we shared a webinar of yours in the past,
Yeah.
and I know that for a lot of the people I'm working with, they are your potential target market because either they have pensions or they certainly know people with pensions,
Sure.
and what you do is help unlock the power of that pension to invest in property. So I'm really pleased you could join us this evening, and I want to say a massive thank you to you for giving up your time for doing this for us, just really welcome to our magical mentoring program, and
Fantastic. Thank you, Wendy.
and thank you very much indeed for running the presentation for us. So I will hand over to you now without further ado, and I'll mute myself so that we just hear your voice.
Fantastic. Well, thank you, Wendy, for that very kind introduction. As Wendy said there, my name is Mike Holt. I'm a senior consultant at the Landlord's Pension, and my presentation this evening is going to be all around pensions. Now, before you fall asleep, because as Wendy said, I know pensions may not seem the most exciting of subjects, my presentation this evening is all going to be around using pension funds to invest into property. I think it's always good to start with an introduction, so I'll introduce myself. As I said, my name's Mike Holt. I started out back in property back in 2004 when I got a job as an estate agent. Boo, I know, we all love estate agents. Now, as an estate agent, what I quickly realized is I was finding lots of great property deals for property investors. And what I very quickly realized is these property investors I was finding these deals for were making thousands and thousands of pounds from these properties I was finding for them. And as an estate agent, I was barely making a few £100s. And that's when I knew I had to find a way to get involved in property investment. I went on to get a job with a large developer in Milton Keynes, and over the next 4 years, I sourced just over 350 below market value properties, mainly through estate agents, but also direct to vendor, stopping people being repossessed. My background is absolutely property, and it's my passion. If you listen to enough of these presentations or attend networking events, you'll see successful people stood up at the front of the room and they'll say, it's really important to have a strong reason why. My experience of investing in property has been that it can be quite challenging. There's lots of hurdles to overcome, and it certainly requires a lot of hard work. And I think it's really important to have something to drive you towards that. And this is my reason why. My partner April, my two lovely children, Lily and Oakley, they're what drive me to want to invest in property and to invest into business. I'm the host of the Berkshire Property Meeting. I've been hosting that now for the last 18 months or so. It's a monthly property network event over in Maidenhead. It's been a fantastic journey, lots of lessons learned, but really enjoy doing that. And for the last 6 years, I've been working with the Landlord's Pension, helping people invest pension funds into property. So how do the Landlord's Pension help people? Well, my presentation this evening is all about money that's already tied up in pension schemes. I'm not going to be on the line here trying to convince you to pay new money into a pension. This is all about money that's already in pension schemes and how we could be using that to invest into property. We also help a lot of people combine and consolidate pension funds. I meet many people when I'm at these network events that say, Mike, I've got 2 or 3 tiny little pensions, but actually, if you can combine the value of those pension funds together, there may be enough to invest into property. Many of us will have these pensions where we've worked for various employers and they'll pay in a little bit and then, okay, we move on and the pension just gets sat there as frozen. So I really urge you to dig out any old pensions you've paid into in the past, because you may be surprised how much is in there now. But if I really had to sum up what we do at the Landlord's Pension, this is all about control. Because I'm sure some of you that are on the line this evening or listening to this recording perhaps have paid into pension funds in the past, have no idea where that money's invested, no idea what return you're achieving, how much you're paying in fees, or even what that pension's likely to pay you in retirement. And I'd like to show you this evening how you can take a bit of control over that money and use it to invest into property or to grow your property business. Now, at the bottom of the slide here, it says 100% of our clients have increased the value of their pension in 2017. This is something we're really proud of at the Landlord's Pension, because we're passionate about helping people grow the value of their pension. And any client that we choose to work with has to share that mentality. They have to want to do something. They have to want to move forward. We're really proud of the fact that so far, anybody that's ever worked with the Landlord's Pension has grown the value of their pension year on year. Very quick disclaimer. It's always important to point this out. The Landlord's Pension are authorised by HMRC to administer pension funds in the UK. We are essentially a pension provider, but we are not regulated by the FCA to give financial advice. So my presentation this evening is all about sharing information with you on how you could take a pension fund and invest that money into property. But please don't take this as advice, me recommending that you should or shouldn't do that. If you require financial advice, you need to go and find somebody that's appropriately regulated to give you that advice. So let's start right at the very beginning. In my presentation, what I'm hoping to share with you is my journey through discovering pensions. What are they? How do they work? Why don't people take any interest in them? And right at the beginning of that was, let's try and get an understanding of what a pension is. And I don't mean the boring financial instrument, a pension. I mean, what really is it? Sure, many of you are familiar with Robert Kiyosaki, famous for the book Rich Dad, Poor Dad, of course. And when I was reading this book, there was three main points about an asset that Robert continually went on about in this book. It really stood out to me. The first one was, an asset is something that appreciates in value or puts money in your pocket, as he says in the book. An asset is something that benefits from compound interest. Apologies, having a slight issue with the slides here. Something that benefits from compound interest, and something that does not require substantial time investment. Now, I meet lots of people that have paid into these types of pensions where you can go online and trade in the stock market. Sounds really exciting when you set it up. You can go on and buy and sell lots of different stocks and shares and manage your own money. But what people have then come back to me and say 5 or 6 months later is, Mike, I thought I could just set this up, spend 10 minutes a week buying and selling some shares, making some money, and my pension would grow in value. But actually, it's turned into a full-time job just trying to keep up with the marketplace. Now, I imagine if I asked people that I meet, do you see your pension as an asset? I would have thought most people would say, no, it's not an asset. It's a piece of paper that comes through the post once a year that some people even file in the bin, would you believe it? But if you have a pension, I would urge you to consider that money as an asset. You will have access to those funds at some stage. I'm going to share with you this evening some strategies of how you could be using that money today. But the big question is, are you giving your pension the attention it deserves? And of course, for most people, the answer is no. So now we've got an understanding of what a pension is. The next question that came to mind was, well, if all these people have got this money sat in a pension scheme, the average pension in the UK at the moment is something like £65,000. And I would argue if you had £65,000 sat in your personal account, you'd be coming to property events and speaking to people like Wendy to find the different ways that you can invest that money to grow the value of your wealth. So the next question was, why don't people pay an interest in their pension? And I came to the conclusion it's a lack of understanding. And this is highlighted by a quote that I'm going to share with you now. This is a quote by the chief economist of the Bank of England in a statement in 2016. And he said, to give a personal example, I consider myself moderately financially literate, yet I confess to not being able to make the remotest sense of pensions. Now, I don't know about you, what really got me here was the chief economist of the Bank of England only describes himself as moderately financially literate. You would expect him to be fairly financially literate, wouldn't you? But you would have to say this gentleman here is probably a fairly switched on man, and even he can't make sense of pensions. So if he can't make sense of pensions, how are you or I or anybody else that's paid into one of these pensions supposed to understand them? So now we've established that people don't understand their pension. So what do they do with them? Well, that's what you have an IFA for, an independent financial advisor, don't you? Your independent financial advisor will look after your pension for you. And one of the big questions that comes to mind is, if the independent financial advisor is looking after your pension, why don't they tell you about alternatives such as investing in property or growing your own business using your pension? Now, I can think of two reasons why a financial advisor may not wish to share this with you. The first one is all to do with how they get paid, which is generally for managing people's funds in the stock market. If you look at the business model of a financial advisory firm, it's typically to get funds under management, charge an annual fee, normally around 1% a year. And as a financial advisor, you build up your client base, you have this money under management, that's your basic salary coming in every year. So why on earth would a financial advisor then call you up and say, I've got a great idea, why don't we take this money out of the stock market and why don't you go and invest it in property? Because if they told you to do that, you then wouldn't be continuing to pay them a fee for managing your funds in the stock market. It's the equivalent of me and my estate agency days, somebody coming into my office and saying, Mike, I'd like to sell my property, and me saying, no, you don't want to sell that, go next door and let it out. I'd be talking myself out of a fee, you just wouldn't do it. The second reason is all to do with risk. Now, I'm sure many of you listening to this presentation probably see property as a fairly low risk investment for you. We even have a saying in this country, don't we, as safe as houses. We like the idea of owning an asset that everybody needs. Everybody needs to live somewhere. There's an inherent value in owning property. But you may be surprised to learn that within the regulated world, and that's regulated by the FCA, which of course IFAs operate within, property is not regulated, therefore it's automatically considered a high risk investment. So when you're going through a risk profiler with a financial advisor, unless you're ticking the box at the bottom that says, I don't mind losing all my money, it's highly unlikely you fit the profile for them to even talk to you about investing into property. It's considered high risk in their world. So if we've got these £65,000 pension funds, they're being looked after by a financial advisor, you would imagine people must be getting a good return on that money, surely, to just make them content enough to leave the money there. Now, I'd like to share quite a shocking statistic with you. It's very difficult to generalize the whole pension market in terms of returns, but one of the most common investments that I come across is an investment in the FTSE 100. Now, if you were to have invested £6,500 into the FTSE 100 20 years ago, just have a think to yourselves quickly, what do you think that would be worth today? £6,500 in, 20 years later, what do you think it's worth? When I do this presentation live, people shout out £25,000. It's incredible. You may be surprised to hear that it would be worth just over £7,000 today. It's an incredible statistic. Now, of course, the FTSE 100 will have yielded a dividend, an income, and BBC Business say over the last 20 years that's been 3% per annum. Now, I can't imagine many of you are out there buying buy-to-let property at the moment yielding 3%. It's not particularly attractive, is it? So there's a very common investment that's held within a pension scheme and over 20 years has not delivered for people. Yet I regularly see this investment still held within pension schemes. Now, if we compare that to property, of course, the average purchase price for a property 20 years ago was £65,000. Today, the average purchase price for a property is £225,000. Now, that's great. That's a great statistic in itself. But what that doesn't take into consideration is when you bought that property for £65,000 20 years ago, the chances are, as a buy-to-let property investor, you would have probably bought it using a mortgage. So you may have put down a 25% deposit on your £65,000 purchase price, but you've benefited from all of that capital appreciation over those 20 years. And of course, you then have an income via rental income, and that's likely to have been higher than the 3% that the FTSE 100 will have yielded over the last 20 years, according to BBC Business. So when you compare these two investments together, it's not surprising, is it, that so many people are choosing to invest in property and have done so now for the last 20 years. Now, I'm sure most of you won't admit to this, but I myself, when I get really bored at night, like to watch a bit of BBC Panorama. And what BBC Panorama were trying to work out is for every pound that you've paid into your pension scheme over the lifetime of your pension, how much of that pound does your provider take in fees over the lifetime of the scheme? It was called Who Took My Pension? I'm sure some of you listening to this may have watched this, but if you didn't, you may be quite shocked to hear that the average amount of fees taken over the lifetime of the scheme was 45% of contributions. So for every pound you paid in, 45 pence of that was taken by the provider. But they did expose one provider for taking up to 80% of contributions in fees over the lifetime of the scheme. If you just think about that for a second, you've paid in £1 and the provider have taken 80 pence of that pound in fees. It's incredible. If you have a pension and you don't know how much you're being charged, please go and find out. It's really important. One of the first things I ask people when I meet them is, how much are you paying in fees for your current pension? And I cannot believe it, but practically nobody knows how much they're being charged. It's really important to find out. Now, I wanted to summarize some of the reasons why I feel that you should be taking control of your pension scheme. We're going to cover some of these points in more detail in some of the case studies I'm going to share later on, but here's just a brief overview. Greater control and scope over investments, being able to fund your own property business and grow your business, being able to increase your returns with your experience and knowledge of investing in property. You can reduce your pension charges, consolidate pensions. You can even combine pension funds with other people. So a spouse or a business partner, you're able to combine pensions. So how do you take control of your pension? Well, we work exclusively these days with a type of pension called a SSAS, a small self-administered scheme. Historically, we've worked with SIP pensions as well, but the restrictions around how you can invest a SIP have changed dramatically over the last 5 years or so. And whereas 5 years ago a SIP was fairly flexible, these days it's very difficult to be able to use a SIP to invest into property. So the common questions I get asked is, who can set up a SSAS? The only requirement to establish a SSAS pension is you must be a director of a trading limited company. That's the only requirement to set up a SSAS. If you can tick that box, you can set up a SSAS pension. Now, in terms of costs, typically to set up a SSAS pension, the charge is going to be anywhere between £500 and £2,500 to establish a SSAS. In terms of the annual costs, most of my clients are paying around £600 a year to administer their SSAS pension scheme. It is not expensive. I meet people up and down the country who have been quoted incredible amounts to set up and administer SSAS pension schemes, but it does not have to be that expensive. Now, it's really important that I point out that not all SSAS pensions are the same. When I put together this presentation, and I've been delivering this presentation now up and down the country for the last 6 years, but one of the fears of mine was that somebody would listen to my presentation and think, great, I need one of these SSAS pension schemes, hop onto Google as we do these days, type in SSAS pension, come across the first provider, go onto their website and set up a SSAS pension with that provider. It's really important to point out that not all SSAS providers are the same. Some SSAS providers operate within a specific sector of pensions, and it's important to align yourself with a provider that works within your goals and works with what you're looking to achieve. So an example of this would be one of the largest SSAS providers in the country, and I'm sure if you typed it into Google would probably come up fairly close to the top. They have a restriction around anything property related. So it's very difficult to invest that SSAS money into a property-based investment. So if you were looking to do that, you wouldn't want to set up a SSAS with that provider. And if you did, you would then find out you can't do what you want to do, and you would then have to move to another SSAS provider, incur more fees. So it's really important, get a plan in place. What do you want to do with your money? And then find a provider that align with your goals. Now, when it comes to funding your SSAS pension, there's a few ways that you can do this. You can transfer in existing pension funds. So almost any pension scheme you've paid into in the past, you can transfer into a SSAS pension. There are a few exceptions. So a government-based pension scheme, so that might be fire service, teachers pension, army pension. They changed the rules in 2015 so that you can no longer transfer those types of pensions. And if you have a final salary scheme with a transfer value in excess of £30,000, you are required to take regulated financial advice to transfer that money. Now, that's not to say you can't transfer it. It's just that there'll be an additional cost involved in transferring it. So again, we need to really sit down and look at the figures. You know, how much are you being offered as a transfer value? Does it make sense to incur that fee based on what you're then looking to do with the SSAS pension scheme? One of the great things about a SSAS pension is that your company can make a contribution. So if you're operating via a limited company at the moment, which you'd have to be to set up one of these SSAS pension schemes, it is possible for your company to contribute. Now, as a private individual, you're limited to how much you can contribute. The limits are £40,000 a year or 100% of your earned income. Whereas those limitations do not apply to a company. So if you've got a profitable company that's making a good level of profit, it is possible for you to negate some of your tax by making a contribution into a SSAS pension scheme. Now, the next part of my presentation, I'm going to be sharing some case studies with you. We work very closely with Your Property Network, which is a fantastic monthly magazine. I'm sure many of you have heard of this magazine if you're not already subscribed to it. But Your Property Network came to us some years ago and said, look, we keep hearing that your clients are doing great things with pensions, and pensions are becoming quite a big thing in the property sector. So they said, would you mind doing a case study every month, just showing what one of your clients has managed to achieve by using their pensions? So we're going to go through some of these case studies now, but here's just some examples that have been featured over the last 6 months or so. So we've got Andy Tunstall used a SSAS to fund his rent-to-rent business. Nicole Barrett combining pension funds with her partner to buy commercial property. Marion Rowson generated a 44% return in just 3 years. And Mandy Wallace is achieving double-digit returns in hands-off property-based investments. So these are some of the case studies that we're going to be covering. And if you subscribe to Your Property Network, you may very well have seen some of these case studies. Now,
Hello, Mike. I'm really sorry. We seem to have a problem with the sound. We seem to have lost the sound. Can you just say hello? I think we've lost the sound. Sorry, everybody. I'll just see what's going on. Hello, Mike. Sorry, everybody. I don't know quite what's happened here with Mike's sound.
Andy, am I back?
Oh, yes, you're back. Yes, fine. Yes,
oh,
sorry.
my apologies. I'm not sure what happened there.
Something must have just broken down. Sometimes with the Wi-Fi, it can, or microphones can be a little bit dodgy. So,
yes. Okay.
So what we heard was, the last bit was when you said that some of these have been featured in Your Property Network. Just to take you back to that point, Mike. Thank you.
Okay, perfect. Okay, so as I was saying, my apologies there, a technical glitch. I immediately heard that the microphone had dropped off because I couldn't hear myself in my ear. So these are some of the case studies we're going to be covering, and essentially it's real people doing real great things using their pension scheme. So the first case study I'm going to cover is a gentleman called Andy Tunstall. Now, I met Andy at a property event over in Reading. He came up to me and he said, Mike, I've got £600,000 in pension schemes. If I could just get my hands on some of that money, I know I could do some great things in property. But he'd been told he couldn't. He was operating via a New Start limited company, operating as a rent-to-rent provider. Great strategy. And as I said, his aim was, can I use some of this money to acquire assets within my company? Now, this particular case study has actually been featured in Your Property Network twice, because we did a short case study and YPN got so much interest in what Andy had managed to achieve, they then called us back up and asked if we would do a full recorded interview, which was published in last month's Your Property Network. So this is what we did for Andy. We set up a SSAS pension scheme, and that gave Andy the facility to loan money from his pension back to his own limited company. Now, there's some limitations around how that works, which I'm going to share in my next slide. But to give you an overview of the story with Andy, he identified a property on the south coast that was up for sale for £200,000. He wanted to buy that property to add some value and rent it out as a service accommodation, but he didn't have the funds.
Sorry, Mike, seem to have lost your sound again there. We'll just wait for you to come online again. Chat amongst yourselves, people. Chat amongst yourselves. Hello, Mike. Hello.
What?
Oh, yeah.
Am I back?
Yeah, you're back. You're back. Absolutely. I can hear you now. Yeah, perfect.
My apologies once again.
It's
I'm not
all
sure
right.
what's going on with this microphone.
I must admit, just a bit of a side point, I tend to use a headset with a microphone, and I do always do my webinars wired directly into the internet, because I know Wi-Fi can be so problematic. What happens is, in your local area, if somebody's downloading a film, or if there's somebody downloading something in your house, again, that's maybe something to to check.
Yeah,
I'm
actually in my office on a wired connection with a wired headset.
No, you should be absolutely fine. You tick all the right boxes, Mike.
I couldn't possibly do a webinar at home with my two children running around. So yes, my apologies. Where did I get up to, Wendy, before I cut off again?
You were talking about this case study.
Yes.
I can't quite remember exactly the last thing you said, but you're telling us about this particular individual and his what he'd done.
Okay, fine.
Andy.
Let's carry on. So, as I was saying, Andy had this money in a pension, had a new start limited company. I'm just covering this off in case any of it was lost. And the aim was to use some of that pension money to acquire assets within his company. Now, Andy went out and found a property that was for sale for £200,000. And he really wanted to buy that, but didn't have the money in his company. And obviously, we were looking at the pension money thinking, how can we use this? Now, one of the great things about a SAS pension is it is possible to lend up to 50% of the value of your SAS back to your own limited company. And it can be done so very quickly. It takes us 48 hours to turn around a loan application. So it put Andy in a fantastic position. Essentially, he could draw down £300,000 from his pension within 2 days. So he went out to see the property. Because he was in a position to move so quickly, he was able to negotiate a purchase price of just £150,000. He managed to get 25% off because he was in a position to move so quickly. Now, one of the other limitations of a pension loan from a SAS is that the loan can only be for up to 100% of the value of the security that's being given. Now, in Andy's scenario here, the property was worth £200,000. It's just that he'd been able to negotiate a large discount because he was in a position to move forward quickly. So we were able to actually get a loan for Andy of £193,000 against a property that he was purchasing for £150,000, which is incredible when you think about it. So this loan from the SAS paid for the total purchase price, all of the associated costs, stamp duty, solicitors, etc., and it paid for the majority of the refurbishment costs of the property as well. So Andy has now got this property sat within his company without using any of his own money, and the pension even paid for the majority of the refurbishment. So Andy's strategy now is to refinance that property, to repay the pension loan, and then repeat the process. He's now, in essence, a cash buyer for up to £300,000 using money that was tied up in his pension. Now, before I started the presentation, we were talking about, not understanding the potential of the pension until you get close to retirement, and Andy is absolutely in that scenario. He's had this money tied up in this pension for all these years, but none of the financial advisors he's worked with, none of the pension companies that he was with told him that he could do this. And now suddenly he's in a fantastic position to really go out and grow the value of his business and his pension at the same time. Now, as I mentioned, there are some rules that we have to adhere to in order for the pension loan to take place. And I've put a link at the bottom of the slide here to the full rules, the HMRC rules that you can read, but I'm going to cover really the main basics that you need to understand. So as I said, it's for a maximum of 50% of the total value of the pension. The maximum term is 5 years. This is a very short-term funding solution. It's not supposed to replace your long-term buy-to-let mortgage. And as highlighted in Andy's case study, this is really a great way of getting in and acquiring the property. And we would then be looking to move that on to traditional finance or to sell the property as quickly as possible. The loan has to be at a commercial rate of interest. But it's quite an interesting thing to get your head around, because if you're paying interest from one of your entities, i.e. your limited company, into another one of your entities, which is your SSAS pension scheme, actually it could be described as an interest-free loan, couldn't it? Because you're just moving interest from one of your entities to another. And of course, the interest is tax deductible within the company, so you're saving corporation tax. And for every pound in interest that you pay back into the pension, remember, you can borrow 50 pence of that straight back in another SSAS loan. But it has to be the commercial rate of interest. So in reality, that means a minimum of around 4% a year, although we encourage our clients to pay as much as they can to save tax and grow the pension. There must be security by way of a first legal charge. So again, referring this back to Andy's case study, this works particularly well when you're buying property for 50% or less of the value of your pension, because you can then give a first legal charge over the property, and you can borrow up to 100% of that valuation, which is why Andy was able to borrow £193,000 against a property that he was buying for £150,000. The loan is also a capital repayment loan, so you're required to pay 20% of the capital back to the pension scheme each year, which again just highlights how it's so important to have a good plan in place of how you're going to repay the loan. Like I said, this works particularly well when you're buying property, adding value, and then either refinancing or reselling in a short period of time. Now, if you're looking at a project whereby it's likely to go on for more than 12 months, what we would say is, well, look, let's leave 20% cash aside of the loan so that we've got enough to repay the first interest payment, and that then buys you 2 years to repay the loan. But if you can tick all these boxes, there is no reason why you couldn't be using your pension to grow your property business today. This is probably the best way to use pensions at the moment in property. Second case that I'm going to share with you is a lady called Chloe from Oxfordshire, 48 years old, came to me, £300,000 in her pension scheme. She ran her own letting agency, and she got a really nasty call one day from the owner of the premises that she was renting, saying, look, we've decided we're going to convert the property and sell it, so you're going to need to move out. And as the director of a customer-facing business, I mean, you can imagine if you put yourself in her position, it's not a nice call to have to receive. You're now going to have to divert your customers to your new office, and could be a bit of a pain. So what Chloe didn't want to do was go and rent another property and find herself in the same position in another 2 or 3 years' time. She wanted to buy a premises, but the company itself wasn't in a position to fund the purchase of a commercial property. So Chloe went online and started doing some research around creative ways to purchase commercial property using a pension, and she came across one of our articles. So this is what happened. She identified a premises for £400,000. We set up a SSAS pension for her. Within her SSAS, she borrowed £100,000 from HSBC, and she's now renting that property back to her own business at market rates. Now, it's very tax efficient to own commercial property within your pension scheme, because any rental income is going into the pension tax-free. Any capital appreciation on that premises is tax-free. And as you've seen there, it's possible to leverage within the pension scheme for up to 50% of its value. So in Chloe's case here, she had a maximum purchase price of £450,000. Now, when a lot of us think of commercial property, we tend to think of a shop and not an awful lot else. But actually, the spectrum of commercial property that you can invest in really is quite broad. So here's some examples for you. Pubs, warehouses, student accommodation, has to be purpose-built student accommodation, of course, care homes, land. There is lots of property that you can buy within your pension scheme. And as I mentioned, it's very, very tax efficient to do so. Now, the final case that I'd like to share with you is a gentleman called Alan from Wiltshire, 51 years old, came to me with £250,000 in his pension back in 2015. And what prompted the call from Alan was he'd just received his pension statement, and he looked at it and said, right, I've got £250,000 in a pension. That's quite a nice figure. If we were to get £250,000 cash out now and put it in front of you, it seems like a decent sum of money. But on his statement, the income that the pension was going to pay him in retirement was nowhere near what he needed. Alan was a director of an IT contract company. It's quite a familiar thing these days. People operate through limited companies in their IT business. He wanted to grow the value of his pension, but he was time poor. He was busy running his IT business. He didn't have time to spend trading his money in the stock market or going out and buying commercial property. So here's what we did for Alan. We set up a SSAS pension scheme, and he identified a type of investment called a property bond, which is essentially a hands-off property investment, similar to crowdfunding, if you've come across that in the past, where you're investing for a fixed rate of return over a fixed period of time. But of course, with property, you have an asset to secure the money against. He split his investment across 2 different property bonds to get some diversification. I sat down with him in December last year, and his pension is now worth £313,000. Now, £250,000 to £313,000, 63,000 gain in 2 years sounds impressive. But what I think makes it really impressive is when we break that down to a monthly gain that Alan's managed to achieve. £2,625 per month growth within his pension scheme in a hands-off property investment. Now, if we put that into context, how many buy-to-let properties have you got to buy and look after and manage to generate £2,625 per month? How many HMOs do you have to buy? It's really good food for thought. And this, remember, is a completely hands-off property investment. Now, hands-off property investing, as I mentioned, crowdfunding, property bonds, the general premise here is that you're getting security over property. And I think it's important to highlight a first legal charge over property. I meet lots of people that have SSAS pension schemes that come to me and say, Mike, I've found a great investment opportunity. They're offering me a personal guarantee and a return of 15% a year. And that's fine. But actually, if something goes wrong through no fault of that person's own, you've got nothing to fall back on. I think it's very important that when you're investing with your pension, you're getting some security for the capital that you're investing. The sort of returns that are on offer in this sector where you're getting that first legal charge of between 6 and 12% with the providers that I work with. And just to highlight again, completely hands-off. So if you want to swap your stocks and shares hands-off investment for a hands-off investment in something you understand that's paying a fixed return, where you're getting security over property, it is possible to do it. And I've put a link at the bottom of the slide there if you want to go and look at some more examples of those types of investments for you. Now, I'd like to dispel a few myths when it comes to pension schemes, because there are plenty of myths flying around, but here's the 3 most common ones I hear. Mike, isn't it going to be difficult to do this? Anything I've done with my pension in the past, there's been mountains of paperwork, lots of time investment. These days, it's very simple to take control of your pension fund. Most of it's done online. At the Landlord's Pension, we strive on taking away the pain of looking after pensions. So we take everything in-house. There's a couple of forms to fill in at the outset, and then it's a completely hands-off process from there. It's certainly not difficult to do this. The next one I hear is it's expensive. I mentioned this at the beginning of the presentation, but again, for those of you that subscribe to Your Property Network, there was a feature recently. Somebody we met at the National Landlords exhibition at Excel London was being charged £30,000 to set up a SSAS pension scheme. They were doing it through a financial advisor. He had a large pension, and the financial advisor was charging a percentage of the fund. £30,000. We managed to set up a SSAS pension for him for just £500. It is not expensive to do this. On reflection, I should have come up with some sort of agreement to split the difference with him, but I didn't. Just £500 to set up a SSAS. It's not expensive. And of course, those fees are paid for by your pension scheme as well in most cases, or by your business as a tax-deductible expense. Now, the most common myth when it comes to pensions is you have to be over 55 to do anything with your pension scheme. I lose count of the amount of people that come up to me and say, Mike, great idea, I'll call you when I'm 55, or you can't help me yet, I'm not 55. Now, it's important to point out to withdraw money from your pension bank account into your personal bank account as a drawdown, you are required to be 55 years of age. But actually, to invest that money into property or to loan that money to your business, as we've discussed this evening, you can do that at any age. You don't need to be 55. So, in summary, you can take control of your pension using a SSAS. The most cost-effective provider I work with at the moment, just £500 plus VAT to pay to set up a SSAS pension scheme. It's not expensive. You can swap the volatility of the stock market for fixed returns in property.
for those of you that keep an eye on the stock market, you will have seen over the last 6 months that the markets have been bouncing up and down. It's really not clear where that's going or where it's heading. Many people feel we're in line for a fall. You can also avoid financial advisor charges. If you want to manage your money yourself, you don't necessarily need to pay a financial advisor as well. In the hands-off investments that I mentioned, where you're getting a first legal charge of a property, it's possible to achieve between 6 and 12% per annum. Minimum required in a pension to consider this is just £50,000. Now, that could be £50,000 across a number of your pension schemes. It could even be £50,000 across a number of people's pension schemes. But £50,000 is where we need to get to. It's all to do with the fees. If you had a £10,000 pension scheme, you would not want to pay me £500 to set up a new one for you. As I mentioned, you can pool pensions with friends and family. We don't advise that you pool pensions with somebody you've just met at a networking event. Ultimately, you're making a financial commitment together. But if you have a business partner who you're connected to via that business, or you have a family member, yes, it is possible to combine your pension funds. And again, please remember, you can do this from any age. You don't need to be 55. Now, on the right-hand side of the screen, there's a link there to download our exclusive SSAS guide. Now, we put this together because there's lots of questions around SSAS pensions. What can you do with them? How easy are they to set up? How much do they cost? What's the best way to invest in property? And we thought it'd be a great idea to put together a free guide where you can read through at your leisure all about SSAS pension schemes. So feel free to head over there and download that. Apologies, it's skipped off the screen. For some reason, my slides are running through automatically, which is putting me a bit out of kilter. But my last slide, which we've just skipped through, is a quote by Jim Rohn. And the reason I share it is I meet people up and down the country and talk to them about their pensions. And I hear all sorts of comments. My pension's rubbish, it's not worth having, I'm being charged too much, it's not going to pay me the income I require in retirement. And whenever somebody says that to me, this quote always comes to my mind. If you don't like how things are, change it, you're not a tree. So if you've listened to my presentation and you think I've got a pension, I've got to do something with it, you have to make that decision, you have to take that leap. I can help you by providing you with the information, but it has to be your decision. Now, in my final slide here, my contact details are on the screen. There's a link to our website. By all means, you can head over to the website. We tried to put the website together being a knowledge base for anything to do with pensions and investing in business and investing in property. So there's lots of really valuable information on there. Some great case studies showing you what people have managed to achieve on top of the ones that I've gone through this evening. Now, finally, I'd like to apologize for the sound cutting on and off. Partway through. I'm not entirely sure why that happened, and actually when I came back online I didn't actually do anything or move any cables. It just magically came back, and again, apologies, my slides for some reason are automatically skipping through, so if I appeared to rush through anything, I would like to apologize for that. Now, I'm happy to answer any questions that anybody has. I haven't checked this chat because I've been focusing on the slides, but if anybody has any questions they'd like to ask, feel free to put them in there. I'm more than happy to answer those for you.
Well, Mike, I'd like to say a big thank you to you. Sometimes, of course, we do have technical challenges on these webinars. It doesn't always go so smoothly. So well done for keeping going despite sometimes I think PowerPoint puts in these kind of automatic timings. And just when you think, oh, what's happened, it moved on to the next slide. So
yes, absolutely, So
we didn't notice that. Let me just say, it looked very, very smooth and professional from our end. So not to worry.
I've opened up the slide with the link to download the SSAS guide because I noticed it skipped through that particularly quickly. And for anybody watching this, I'm sure it's definitely worth downloading that because it's some really valuable information. So I'll just leave that up on the screen whilst we answer any questions if anybody has any.
Yeah, excellent. So Amber did put in a question earlier on. Is it possible to joint venture, to JV with someone who has a SSAS pension?
Okay, brilliant. Thank you, Amber. Great question. Now, it depends on what we're defining a joint venture as. So let's go through a few scenarios here. So let's say you're the property investor and I'm the SSAS member. So it's my SSAS pension scheme. I've got some money sat in my SSAS pension and you would like to use some of that money to invest into property. Now, what we could do
is I could loan my pension scheme, or a proportion, whichever, to a third party, genuinely diverse commercial vehicle, aka a limited company. So as long as you're operating via a limited company, I could lend my pension scheme to your limited company, and you could use that money to invest into property. We could agree a mutually beneficial arrangement where you pay me a fixed rate of interest. Usually, you would be required to provide some form of security for that loan as well. So yes, that's absolutely possible to do that. Now, if we look at the other type of a joint venture where perhaps you're jointly acquiring an asset together, so my SSAS pension, your limited company want to jointly purchase a property, that does become problematic, because one of the main restrictions around pension schemes is that you cannot directly acquire a residential property, or indirectly acquire, for that matter, a residential property. It's not possible. It has to be commercial. So if my pension was going to jointly own a part of this property, Amber, with your limited company, that property could then not be residential. So if you wanted to buy a commercial property and rent it out, yes, you could joint venture in that manner with somebody's SSAS pension. If you're looking to buy a commercial property and potentially convert it into residential, that's going to cause problems. Now, I appreciate that by saying what I've just said, it might contradict some of what I've said in my presentation. But when you're making a loan to a third party, you're not acquiring the property. You're making a loan to a business. What that business then does with that money is irrelevant as far as the SSAS pension is concerned. So some examples of that are, for instance, a crowdfunding investment, where you're investing in a crowdfunding investment that's then buying residential property. That is permissible within a pension scheme, because you're simply making a loan to a third party, genuinely diverse commercial vehicle. What that third party is then doing with the money is their business. They just have to adhere to the terms of the loan. And similarly, when you're loaning money from your SSAS back to your own limited company, again, it's none of the pension's business what the company is doing with the money. But if you were going to invest into a project where the SSAS would jointly own the asset, if it became residential property, that would cause real problems. And it is important to recognise the charges that HMRC would put on the pension scheme if it was to at any point own a residential property. So HMRC can levy a charge of up to 55% of the value of the investment that's made. So if I was to invest £100,000 into a residential property with your company, Amber, HMRC could essentially fine me for £55,000 for owning part of that residential property. So that's why anything to do with jointly owning residential property doesn't work within a SSAS. But I'm sure you'll meet many people on your property journey that have money tied up in a pension that you would be able to offer them a much better return and better security via that loan scenario that I talked about. Okay, does that answer your question, Amber?
If you can message in the chat panel, Amber, then we know whether that's been sufficient. Another question from Amber as well, Mike. I know a lot of doctors who have great final salary schemes. Are they allowed to have a SSAS?
Unfortunately not. Doctors are part of the NHS pension scheme typically, and I should put a caveat in there. Not all doctors are part of the NHS pension scheme, but I would imagine the vast majority of them are. And the government stopped anybody transferring out of a non-funded government-based pension scheme back in 2015. Just to give you a bit of context as to why, I don't want to bore you with it. I love pensions, but I appreciate that not everyone may share my passion. But essentially, if you imagine they introduced these new pension freedoms in 2015, where you could draw down as much or as little of your pension as you like. Prior to that, of course, you could only purchase an annuity, or the government actuary department would dictate how much you could draw down each year from your pension. So final salary schemes used to be like this golden plated pension. You know, if you got a final salary scheme, you're really lucky. But when they introduced pension freedoms, their worry and their concern was that people in these final salary schemes would go, hey, actually drawing down from my pension and drawing down freely as much as I like sounds quite attractive. I'm going to get out of this final salary scheme, draw down from my pension scheme, and I can even leave it to my children when I die. Now, if everybody in the public sector had decided, actually, I quite like these new pension freedoms, I'm going to transfer my pension, the government simply could not fund it.
these pension schemes are tax funded. So essentially tax comes in and the pension payments go out. There's not a pot of money that they draw down from. So in answer to your question, I would absolutely be saying to, if one of them phoned my office, I would be saying, is your pension an NHS pension? If it is, you can't transfer it. But if it is an NHS pension, because doctors are generally high earners, they're normally recommended to pay into what's known as an AVC, an additional voluntary contribution. Now, some of these AVCs might be quite substantial because, of course, they're high earners. And that pension pot sits completely separate to the government-based final salary scheme. So if the doctor has an AVC pension, they could be using that within a SAS pension in the manner that we've talked about this evening. Okay, hopefully that answers your question. Happy to clarify if you need me to.
Great. Okay.
Just scrolling through it.
Thank you.
I'll let you take the questions, Wendy.
Yeah, it's easier perhaps if I sort of moderate them, so to speak. Okay, so question from Charlotte. She's 30. She's got a current pension of less than £50,000. Is it possible to move that into a SAS?
Okay, so the answer to your question, Charlotte, is yes, it is possible to move your pension. You could set up a SAS pension scheme with no pension if you wanted to, but it all comes down to the cost effectiveness of doing so. So the reason why I mentioned the £50,000 is, as you saw in one of my first slides, we've got this great record where everybody we've ever worked with has increased the value of their pension year on year. And the reason why that is the case is because it'd be very easy, and obviously as somebody that earns money from setting up SAS pensions for people, it'd be easy for me to say, Charlotte, yes, let's set up a SAS pension for you, it'll be great. You put your money in the pension pot, but actually the annual fees are probably likely to be equal or more than the return that you'll be able to generate within the pension scheme. So to answer your question, if you had just below £50,000, £50,000 is a nice even number to sort of say, well, look, that's really the entry point. If you were to have slightly less than £50,000 as a company, we may look to come up with some sort of arrangement with you where perhaps we split the cost of you setting up the SAS over a number of years to really try and help you to boost the value of your pension. But if it was, say, less than £40,000, it's really going to be very difficult for you to do that. Now, there's a couple of things you could look at. The first one is, are you in a position to make some contributions to grow the value of the pension, to increase the pot size? The other thing is to look at where it's invested at the moment, how much are you being charged, and see if there's any way of you being able to maneuver that pension in the short term so that you can get to the value it needs to be quicker to then look at a SAS pension scheme. That's what I would say.
Great. Okay. Thanks, Mike. By the way, I'm just muting myself when you're speaking, so there's no background noise. So there's a bit of a delay on the line. But yeah, fantastic. So I think it sounds to me like it's about weighing up the options and looking at the cost effectiveness of which route somebody might choose, isn't it? Absolutely.
And like I said, if you contact me and we have a look at the situation, I will tell you openly and honestly whether I feel it's worth your while considering or not. Our reputation has been built out of helping people move forward, not around trying to get fees out of people. So we could have an open and honest conversation as to whether it's in your interest at the moment to consider it. But if we come to the conclusion that it wasn't in your interest right now, that's not to say that at some point in the future that may change.
Yeah, absolutely. Okay, question from Tarek. Thank you, Tarek, for your question. From a property investor's viewpoint, which type of people should I be talking to about maximising their pension?
Brilliant, fantastic question there, Tarek. And I'm still trying to learn that for myself, being somebody that operates in the industry. But I think what I would say is that anybody that's at a property investor meeting, that has an interest in investing in property, it is likely to have some sort of a pension, because if we look at the type of people typically, and we're generalizing a bit here, but typically the people that invest in property may be investing in property because they're getting their pension statement and it's not going to pay them a sufficient income in retirement, so they're looking for alternatives. I mean, that's a very common scenario I hear when I travel around to these events, and the other speaker will say, I got into property because my pension was rubbish. So you know, I think it's about networking, asking the question. You know, we've got to be a little bit careful about you know, jumping in there and assuming that somebody is going to want to move their pension. But what I would also say, whilst we're on the subject of, you know, you having conversations with other people, is, you know, this free SSAS guide that's on the right hand side of the screen here is really a great resource for you to be able to use when speaking to your clients as well. Because if you start speaking to a client about, you know, pensions and investing in property, etc., you know, they're probably going to say, okay, well, that sounds interesting. You know, they may have some questions. You may or may not be in a position to answer those questions for them. But actually being able to say, well, look, you know, I know a bit about this because, you know, I've spoken to some people that are doing it, but it's not my area of expertise. But I do have access to a guide which will guide you through the whole process of, you know, how this works and the benefits in doing so. But yeah, back to your original question, it's very difficult to say. I wish I had the answer because I could save my time, couldn't I? But yeah, you know, the chances are most people that you meet or speak to in the property sector are likely to have paid into pension funds in the past. Hopefully that's giving you some sort of indication, Tarek.
Okay, Brill, thank you ever so much. So it sounds to me that, Mike, one of the, for people thinking, right, okay, what's my next steps now? It's about having an awareness of how you can use pensions and how pensions have different structures that you can use to invest in different types of property. And I think your webinar tonight has really helped us to understand that and to see that. But it's also about actually developing a relationship with the investor and exploring these areas, and then maybe coming to you and saying, okay, Mike, here we have Bob, for example. My examples always seem to be called Bob. Here we have Bob, and he has a pension of £80,000, and maybe it's a SIP. And you know, what are the rules around his pension? How can we best use his pension, and how can we make sure that we're investing in the right type of property for his particular pension needs, so that we're all benefiting from it, and it would be beneficial for people to kind of come to you, I suppose, with a bit more of a specific request, a specific pot of money, so to speak, so that you can then give them detailed personal advice, can't you?
Sure, absolutely. And you know, I work with lots of people on that basis, whereby you know, speakers that are around to network events may come across people that want to invest in their business, for example. Lots of people that are speaking at events are looking to raise capital for their own business, and they'll meet somebody and they'll introduce them over to me and say, Mike, this is Bob. Bob would like to make an investment into my company. He's got some money in his pensions. Can you help him? And you know, our response would be, yes, we're happy to explore the options with Bob, you know, in terms of, you know, whether he could set up a SSAS pension scheme, whether it's the right thing for him to do. You know, we would certainly be making sure that all of the information that we provide to Bob would be very much, you know, generic. This is a SSAS, this is the cost. You know, we certainly wouldn't be recommending that they make any sort of investment, but at the same time, you know, from the person that's introduced Bob's perspective, you know, they don't have to get to know SSAS pensions or how they work or who's entitled to one. You know, they can just come to me and say, Mike, here's Bob, can you help him, please? And we work with a lot of people on that basis. Okay,
yeah, that's really helpful. Okay, more questions. We won't go on forever here. Perhaps another 5 minutes of questions, because I realise it's later than we thought now, Mike, and I really appreciate your time.
Oh, yeah, absolutely fine by me. Yeah,
that's great. Thank you. So, question from Amber: This is an interesting one. Can you borrow £30,000? Let's say you take out a personal loan, stick it into your pension, get tax relief, and then add it to your SSAS.
Amber, that is absolutely thinking outside the box. I like it. Okay, so I would probably start by saying, Amber, it's you know, it's a good question for your accountant. You know, perhaps not a great question for me, but let's just talk through the common sense approach. I'm a big fan of the common sense approach. Now, if you had earned income of £30,000 or more for that year, then you would be entitled to tax relief on £30,000 worth of contributions. Now, of course, when you're paying in, for every pound you're paying in, you're getting 20% added into the scheme as tax relief.
which is a nice bonus, and that's the reason, of course, why we pay into the pension scheme. But let's say you took your £30,000 income and you just stuck it straight in a savings account. You then took a £30,000 loan and stuck that in the same savings account, and you then decided you wanted to make a contribution to your pension. Would HMRC be able to decide which £30,000 was or wasn't your income, or which or was or wasn't the loan? No, they wouldn't. So I would say my view on it would be, yes, you probably could do that if you're entitled to £30,000 worth of tax relief, which means that you've got an earned income, and earned income means income through a job, essentially, not through investment income. Has to be earned income either through PAYE on your own limited company or through PAYE from a company you work for. But yes, if you were entitled to that amount of tax relief, and of course tax relief can be backdated for 3 years, so even if you'd earned £10,000 a year for the last 3 years, you'd be entitled to £30,000 tax relief. And I cannot see how HMRC could possibly distinguish between a loan or your personal savings. So my view would be, yes, you probably could do that. However, I would absolutely say it's a great question for your accountant, would be my overall answer.
Yes, I agree. My understanding is that to pay into a pension, it has to be earned income. But that's my understanding. I don't think you can borrow money to put into a pension.
No, you're absolutely right, Wendy. But I think the question mark around it would be that if Amber had earned income of £30,000, if she had earned income, so she's entitled to tax relief for £30,000. How could HMRC possibly distinguish between a loan or what Amber's done with that £30,000 after she'd earned it? I don't think they could.
Yes,
so,
yes.
I mean,
that's
like I said,
very clever. I like that. Absolutely. So as long as you can demonstrate you have actually earned £30,000 at some point, then he could say, well, I have earned £30,000, but it just so happens that the £30,000 I put into my pension is not that very £30,000 I earned. But yes, I take your point. Yeah, I take your point.
I couldn't see how they could distinguish, but yeah, really like that outside of the box thinking. Yeah, great.
Interesting. Okay, so Amber's got lots of questions. He's always somebody who has lots and lots of questions, Mike.
Right. Okay.
You may want to speak to Mike directly. Do you have to verify FCA 13/3 if JVing with a deed of trust apart from the direct loan for his loan?
Amber, I wouldn't be able to comment on that because of my answer to your first question around JVing with SSAS pensions and the fact that essentially the only way of JVing is via a loan, a fixed rate of interest. It's not something I have sufficient experience to be able to answer your question with any confidence, to be honest.
Okay, cool. And then there's another question about allowances. So this is more about pension allowances, I think. I assume you have allowances that go back or forwards. Sorry, my eldest son has just arrived. Just let me just close it. Hello, Luke. It's lovely to see you. Would you mind just closing the door, please? I'm on a webinar. This is family life for you.
Yeah, absolutely. I know it well. Yeah, this is a treat for me, getting out of the house for the evening.
Yes, that's right. Absolutely. I could do with an office where I could retreat quietly.
So in answer to the question, Amber, yes, pension contribution can be backdated for up to 3 years.
Yeah. Okay. Cool. Okay. Brilliant. Right. Okay. I think unless anyone can correct me, or if you think we haven't had you haven't had your question answered, please repeat it in the chat panel. I'm trying to keep up. There's lots and lots of comments and questions, which is great. It shows you've been listening and you've been engaging, which is what I like to see.
Well, I tell you what, Wendy, I did spot one question which I didn't answer from Charlotte, and the question for everybody in the group was, also, can a pension be used towards a purchase? How would a first charge work, etc.? So we're talking here about whether, I assume, Charlotte, sorry, we're talking about if we were to loan money to from a SSAS to the company. obviously the pension needs a first legal charge. So could it be used as a deposit, I suppose, is your question there. Now, the answer is no, and it's one of the restrictions around this pension loan setup is that because the pension has to have a first legal charge, it is a HMRC rule that the pension has to have the first ranking charge over an asset. You wouldn't then be able to get a mortgage on that property because, of course, the mortgage is likely to want the first legal charge. So that's why this setup works particularly well if you're buying property for less than 50% of the value of your pension. So, for instance, in the Andy Tunstall case study I went through, he had £600,000 in his pension, but he was looking to buy property around the £200,000 mark because, of course, that's less than half the value of his pension, which means the pension can fund the whole loan and take the first legal charge in lieu of that loan. So, but it's a great question, but unfortunately you won't be able to do that.
Okay. Another question about a minimum allowance that you can contribute to your own pension. So let's say you set up a SIP, for example. Is there a minimum contribution you can make every month, even if you have a low income?
Okay, there is a statutory right to tax relief. Trying to think off the top of my, I think it's about £3,700 a year that you can receive tax relief on, even if you're not earning anything. So a lot of my clients earn the majority of their income through property investments, and of course that it's not classified as taxable income; it's investment income. Therefore, it's not classed as earned income; it's classed as investment income. Therefore, it can't be used for tax relief. So they will pay in the statutory amount, which I think is about 3,700, but that it's around 3,700, I know, but I'm not entirely sure it's exactly 3,700. But I'd be more than happy to send you over the link to that. Okay. Again, we tend to anything tax related, and tax means tax relief as well. We tend to say, look, accountants are the best place for that. Anything to do with the SSAS pension, what you can do with it, the rules and regulations within a SSAS pension is absolutely my area of expertise. But the tax side of things, naturally, I know a little bit about it because it's in my day-to-day business, but it's certainly not my area of absolute expertise.
And I think this is where having that power team around you who will give you advice on all different aspects of utilizing pensions, tax relief, managing your money, a bookkeeper or an accountant who will actually manage the day-to-day operations of your business, somebody else who can actually advise on tax as well, which again is related but a secondary and a specialist field in its own right. We, as property entrepreneurs, we need to know all these different people. You might not use them on a day-to-day basis, but you certainly could use them a few times a year. And I think having these connections and having the network there is very important for that.
Yeah, I'm absolutely a great believer in that, Wendy. There's my phone book is full of people that I haven't spoken to for a year, but at some point I'll need them, and I've got their number there, and it's about growing that team, isn't it, and having the right people there. Should you, now if anybody's out and you meet somebody and they have a pension, you think, well, actually, look, I've listened to this presentation, I've got Mike's number, I can introduce you to somebody that knows something. And I think my experience in property investment has very much been, it's a people business. And if you can help somebody else, the chances are that they're likely to come and help you in some way as well in the future.
Absolutely. Well, I would like to say a very, very big thank you to you, Mike. It's been very eye-opening and elucidating, and I've heard you speak a couple of times, but I've learned some stuff tonight as well. It's made me think about our pensions, which aren't huge, but I can talk to you about that another time offline. But I think that for the group tonight that's listened to you, I can see they've really enjoyed it. They've really engaged. So I think, team, we probably all want to say a big thank you to Mike, don't we? And I'm not going to unmute you all because we'll be overwhelmed with noise, but maybe if you want to say something in the chat panel and just say thank you to him before he goes off and hopefully has some time of the evening left. I don't know whether you've got child rearing jobs that you need to be doing, Mike.
Oh no, my children are in bed asleep by 6:30. I'm like they call me the drill sergeant at home. No sugar in the morning and bed by 6:30. They're my two rules that they live by. So there we go. But thank you so much, Wendy, for inviting me along this evening. Again, apologies for any technical glitches we had there and the slides skipping through. But hopefully, everybody that listened to this evening and listens to it in the future will get some value. Any questions at any time, always on hand. So please feel free to get in touch with myself or one of my team. I don't tend to take on many new clients at the moment. I deal with just under 200 individuals, SSAS pension schemes personally, and of course that takes up an awful lot of time making sure that people are moving forward in the right direction. But we've got a fantastic team here at the Landlord's Pension of consultants, and any one of my team would be really happy to help you with that.
Brilliant. Great, lovely. Well, thank you very much indeed. And
thank you for your kind words.
You're very welcome. And, I'm sure that many people want to follow up from this evening's webinar. So all the best to you, Mike.
Fantastic. Thank you. Goodbye.
Bye.